really all Powell uses these things for is for to hint at what's happening in the next couple of meetings and tell us what the data has been doing recently, which we all already know. So he's basically said, we're not quite there in July, but things are moving in the right direction for September. So, okay, I mean, if he has to move from that, he's going to end up shocking markets before he even gets to the meeting. But that's kind of the message we've got. It's probably the most likely scenario based on the fact that he's the one doing the thinking. So it would take some big surprises, I think, to shift them off that path. But definitely, I think they are preparing the way for cuts, and September looks the more likely meeting. We're also going to have Jackson Hole around that time, and that's often a time that the Fed uses to sort of take a breath and reset on the general trajectory.
I'd like to welcome back Dylan Smith to Wealthion. Dylan is the Vice President and Senior Economist at Rosenberg Research. Dylan, welcome back. It's always great to have you with us.
Good to see you again, Andrew. Thanks for having me on.
So I know we were just talking, but give it to me again, your overall take, and I'm sure it'll take a couple hours, but your take on the present state of the economy.
A couple of hours, yeah. I'm sure our listeners will tune in for that. Yeah, I mean, so let's go over the macro picture we're in now, just to remind everyone where we are. What we think we're experiencing right now, especially in the U.S. economy, is a real slowdown. We've been calling for it for a while. It's taken a little longer than we expected to come, but everything is pointing in that direction now, and it's actually quite easy to miss if you're a little bit complacent. But the macro data have turned remarkably weaker compared to where they started the year. So, we have inflation came down from 9% to around 3% now, stalled for a little bit, and has continued on its way down. So we're seeing that disinflationary story continuing. We can get into it later, but there's only really a couple of things still holding inflation at that 3% level. Underlying is looking a lot lower. So very little to be concerned about there. And in the meanwhile, we're seeing the labor market starting to crack up in quite a serious way. And we're seeing the growth numbers coming. It looks like GDP is going to have a one handle again. And the sort of underlying growth numbers that you get from all the survey data, the so-called soft data, very, very weak. But I think the biggest and most important thing that we're seeing in the data flow, and something that can be easier to miss if you're not paying attention, is just the sheer degree of revisions we're getting all over the place. So the ones on non-farm payroll and employment numbers that we got last week, those obviously got a lot of attention because they were big and they were the latest in a long string of revisions that undermine the message from the headline employment numbers. But it's not just there. We're seeing it all over the place, whether you look at IP, whether you look at capital goods, basically anywhere you look in terms of the U.S. data flow on series that are revised, they are being revised. So recent history, a picture of it economically is changing pretty quickly. And I don't think we can show it now, but we got to basically put together an index on revisions going back into the 90s, which is kind of where you can get this data back to. And if you look at that across the various sectors of the economy, we're at sort of 99th percentile lows in terms of ongoing downward revisions. And the one thing we do know about the revisions is that they are highly cyclical, highly, highly cyclical. If you think about the incremental information that comes in to surveyors, if you're getting a softening economy, that's going to come in incrementally weaker and weaker. So as your sample size increases, and as you collect data week to week and add it to the sample and improve your sampling for the month, you're going to get a downward revision compared to what you sampled in the first week of the month, right? And that's a consistent pattern that's been happening, and that's why it's so pro-cyclical. Equally, upward revisions tell you the economy is on an upswing. We're definitely not there. So we're taking that as a very meaningful signal. We're not overlooking it. That's something that has consistently happened. When I was covering Europe back in 2014, just after the crisis, we were seeing the same thing happening. Our revisions were already the leading signal of a big softening coming. And so, that's kind of the economic backdrop that we're seeing. And yet we have interest rates still historically tight or, above sort of equilibrium levels. And the Fed saying they need to maintain that tightness until they are quote unquote confident that the economy is on the right track in terms of inflation. So a real risk building up that, there's still lagged effective policy in the pipeline, and that pipeline is being extended. And so the picture we're seeing is one of current softening and future softening to come.
So I guess early in the year and late last year, we were keeping our eye on CPI, which we'll get Thursday, PPI, which we'll get Friday. But all of a sudden now we're hearing about unemployment, and they're keeping their eye on the unemployment number.
Mhm.
I go back to last Friday, as you alluded to, we got employment numbers that came in, unemployment up to about 4.1%, which I guess the Fed looks for about 4. So unemployment is rising. Explain to us why unemployment is so important, because I think Jerome Powell, who's testifying on Capitol Hill now, actually mentioned unemployment. And you want to keep unemployment if it goes too high, we're entering a recession. Goes too low, there's inflation. So it's real important to keep unemployment at the perfect level. I don't know what that is, but explain to us why.
If you knew what it is, you could govern the central bank. But look, the Fed has an explicit dual mandate that comes down to it. And it says you have to focus on price stability and keeping inflation low, which they interpret as 2%. And you have to control unemployment and make sure that that real side of the economy is functioning smoothly, right? So Jay Powell's sort of song for the last, say, 4 or 5 Fed meetings has been, listen, we're actually laser focused on inflation. We're almost there, but we just need to be confident that it's going to get down to 2%. I don't know what's going to give them that extra confidence. I guess increasingly a 2% print is what will give them confidence that it's at 2%. And he's been saying, or if the labor market just breaks down all of a sudden unexpectedly, we're obviously going to have to cut rates as well. Now, neither of those two things have exactly happened, but what we're seeing, especially when you scratch below the headline unemployment, NFP number, is that the labor market really is easing up, and it's happening in two sources, both on the supply side, in terms of supply of labor and then demand for labor. Right. So we're seeing labor force participation picking up, people coming back into the labor force. That's generally a sign that whatever they were living on is not taking them quite as far as they thought, and so a signal really of underlying kind of weakness generally. And then you also have sort of immigration pushing up labor supply at the same time as well. So that's opening up. That's always disinflationary. And at the same time, on the demand side, you're seeing job openings reaching levels now back to where they were just before COVID. So we're back in a quote unquote normal labor market, and continuing to sort of open up more and more. So demand for labor is falling. And so those, outside of a couple of sectors, notably healthcare and education, sort of tight services sectors, we're seeing a real dip off in labor demand. And so what that means is it's a generally soft economy. As you said, these things go hand in hand. The easier the labor market is, the less worried you get about inflation. And so all that's pointing towards, there's just no way. If you ask an economist and you said, hey, unemployment in the U.S. Has risen almost 5 percentage points from the dip in the last 12 months in the 3-month moving average terms. Inflation's a little bit above target. It's now around 3%. And GDP is printing with a one handle. Where do you think interest rates should be? They're not going to tell you over 5%. No ways, right? So we're in a really, really restrictive economy. And so when you look at this labor market data, and you take a cold hard stare at the underlying on the inflation as well. And that tells you that the Fed should start cutting. And I think, we're going to see in the July meeting. Today we've heard in the testimonies that probably they won't be cutting, but it's not unlikely that they'll pave the way for a cut at that meeting.
Yeah, the July meeting is at the end of this month, and then we have the September meeting where it looks like, and from all indications, and you look at all the probabilities, and we could probably bet on it. It sounds like September is going to be the first cut, and then they run into a problem where if they're going to cut in September, we now have an election in November. You don't want to be looking at cutting and possibly influencing the election at all. I guess that's how they look at it, right?
Yeah, that is how they look at it. Look, they're coming from a very tight position. We've done some work on what policymakers do in the lead up to elections, and actually, there's no consistent pattern. If they need a cut in the couple of meetings before an election, they actually will. It's not like you see policy kind of holding for the whole year and then suddenly changing afterwards, right? They've actually been quite good, and I think have improved their credibility by telling a consistent story and making the moves when they will. So I think that's why September, it's also far enough from the election. I think they buy some insulation. The election itself probably does put more question marks than there would be on the subsequent meeting. But the other conversation you usually hear in markets is, oh, December liquidity, everyone goes on holiday, liquidity is low. That's not a good time to cut. They've cut in December before. So, it's quite possible we just get a shift in a cut that would have come in October. It comes in December instead. The more important question is, when do they press go on the easing, and then how far do they ease? And a lot of people only have a sort of 3-4 cut easing in total, which would still leave them restricted. It would still be saying, we think the economy is too hot, or it would be saying we think the neutral interest rate is like 4% now, which I don't think anyone believes. So we think there'll be a lot more to come. And the pace will depend, I think, in all honesty, from the Fed's perspective on how fast all the indicators are moving. If inflation stays below 2%, goes down through 2% and sticks there and even gets, starts flirting with outright deflation, you're going to see them cut very aggressively. But either way, they have to go down to sort of 2.5%, just to set themselves to neutral and say this is where we want the economy to be ticking along. And I don't think that's widely recognized as it should be by markets.
Dylan, by all indications, depending on how the election goes, the inflation, under Trump, inflation, the talk is that it could rise rapidly. And if Biden wins the election, or whoever, I guess, the Democratic nominee is going to be, wins the election, inflation should continue just the way it is. The question is, how careful does the Fed have to be going into the election? Whereas if they cut too much and inflation all of a sudden ticks up, now they have to raise rates. Or are they thinking, we'll do this real slowly into the election and then figure out from there where the numbers are flowing?
I think we're actually past the point where rate action now has a meaningful effect on inflation before the election, right? These things happen with pretty slow lags, and the forces that are pulling inflation down right now have been building up from 2+ years of tight monetary policy now. So even if they ease, they'll be restricted. So unless they cut enormously, historically unprecedented cuts, they're not really going to move the needle much on inflation to the election. So I don't think that's the major risk in terms of cutting. Now, I think where it starts becoming very challenging is what happens after the election, and where does it leave the Fed's framework in terms of how it thinks about the economy in relation to fiscal policy. Right? So, I think you're right to diagnose that a Democratic win, which would in all likelihood come with some power sharing, most likely with a Republican Senate, that would curtail the ability to do really a whole lot on the fiscal front. Biden's already said, and perhaps Biden's Democratic successor would follow this, but Biden has already said that that he'll keep most of the tax cuts that we got from Trump, but that he'd allow some of the taxes on very high income people to reset. So nothing major happening on the tax front really, and I think Democratic spending plans are all done. Right, there was an enormous opening up of the fiscal taps in the first term, and that's just basically got to play out. It won't be pulled back. Now, similar actually, if there's a split on the other side, if Republicans win the White House but don't manage to win both houses of Congress, again, the blocking power will probably be sufficient that you just end up basically status quo on a lot of the fiscal stuff. But the odds of a Republican sweep have gone up since the debate. And that's the scenario where you really see, in addition to the fiscal situation already being somewhat untenable, it gets worse quickly because there's all sorts of tax cuts coming down the pipe. And what we know also about Trump is that he likes to be popular. He doesn't like to take things away from people. And so you don't get the spending offset either. And so you get a big opening of the fiscal taps. That is certainly negative on the debt side. It's negative for the long bond. In fact, we probably have to rethink our bond call quite seriously if we got that kind of result, because we're pretty bullish on the 10-year and the 30-year, but not conditional on a Republican sweep on the election. So we'd have to have a hard think and see what happens afterwards. But that would be inflationary. And the Fed would want to lean on that a little bit. So, to the extent it's in a cutting cycle, it probably slows the pace of cuts a little bit. It probably means that they terminate a little higher than they would have otherwise, all on the margin. But Trump also likes low interest rates, right? So we start getting some pressure on the Fed. Powell gets told he's never getting another term. We don't know who comes in next, and markets just kind of start having a little bit less credibility in Fed policy. So that's the bad outcome in terms of kind of the Fed and the economy from the election. And what it then leads to is a case of fiscal dominance, where really it's fiscal policy that's driving the economy. And I spent a long time covering emerging markets in a past life. That's not a situation you want to be in. And so that's something to think quite hard about. Now, of course, inflation always has winners, so investors can think through, who benefits most from this kind of outcome. But in terms of, nice, stable management of the economy from the Fed, it makes their job a lot harder.
Yeah, and Trump has already said he wants to be the Fed chairman. So if he wins, Powell is certainly out, and we're going to have zero interest rates, it would seem. But I joke. But the as I said earlier, the CPI comes out Thursday, PPI comes out Friday. In your research, any expectations as to what we might be looking at?
Yeah, so I think markets are currently, or economists are predicting 0.1% month on month on CPI, and I think 0.2 on core. So, that would be similar to what we got last month and pretty soft already. I would say the risk of that is probably actually to the downside, because one very positive development that we saw last month was we got a little bit of a ticking down in auto insurance and insurance generally. That is one of the three things that has been holding inflation above target. It has been, it's basically lagged effects of that industry catching up on the prior run up in automotive prices, higher theft rates, higher accident rates, higher cost of replacement rates. So all of that has already happened, and we're just getting the price impact now. We've done some modeling on sort of the typical lags around that. It should be slowing right now, which is what we're seeing. And so I'm not sure if forecasters all are aware of that. So the risk, I think, to the point one is that we get a little lower, even flat on the month. All of which, again, builds into the case for the Fed to start cutting, if not in July, then certainly in September. I think that will start to lock in on almost a done thing if we get that inflation number.
Yeah, on Tuesday, I think Chairman Powell, as we record this, I think he has intimated that things are softening and things are trending in the right direction. What they're doing seems to be working, as he puts it. Do you think he's given hints to an upcoming rate cut?
Look, these testimonies have gone from being really interesting, really sometimes challenging to pass, treatises by past Fed chairmen who have been really great thinkers. Post-crisis, we had Bernanke, drawing on all his research about the Great Depression and what kind of moment we were in, and how he was thinking through the state of the world and the state of the economy, and way beyond the data. Same with Greenspan. And really, all Powell uses these things for is to hint at what's happening in the next couple of meetings and tell us what the data has been doing recently, which we all already know. So he's basically said, we're not quite there in July, but things are moving in the right direction for September. So, look, I mean, if he has to move from that, he's going to end up shocking markets before he ever gets to the meeting. But that's kind of the message we've got. It's probably the most likely scenario based on the fact that he's the one doing the thinking. So it would take some big surprises, I think, to shift them off that path. But definitely, I think they are preparing the way for cuts, and September looks the more likely meeting. We're also going to have Jackson Hole around that time, and that's often a time that the Fed uses to sort of take a breath and reset on the general trajectory. So we'll see what comes out of that.
It seems like the cut will be about a quarter point. Is that going to move the needle at all?
Yeah, that's the interesting thing about cutting. The individual cut does almost nothing. The first cut's very important because it tells you you're starting, and so you tend to get a. This is why the Fed and economists like to measure financial conditions broadly. What is the state of access to finance in the economy? How prohibitive or how easy is it to get it? Whether through different instruments, direct borrowing, equity, blah blah blah. So what you find usually is that the first cut will do a little more in terms of easing financial conditions, because all that uncertainty around is there a cycle coming gets priced out, and you get financial conditions kind of easing. So it's more about the signaling, about the Fed saying, we are moving into a phase from restrictiveness to gradually easing. And then the debate becomes about how fast. And it's not just the actual cuts, it's how quickly and how deeply do markets think that the Fed will cut, because that tells you what happens on longer bonds, it tells you what happens on the yield curve, and that's ultimately the main way that policy gets transmitted through the economy is, you get more or less borrowing depending on how steep the yield curve is. And that's where I think we need a little bit more debate. And there's a lot of focus on the September meeting. I think more important is how much does the Fed actually need to do when it starts doing it, and how quickly should it be doing it? And I think that's where we're a little out of consensus in saying this is going to be pretty deep. We're going to get sort of 200 plus basis points of cutting, and they'll do it quicker than people think. It will go meeting by meeting. We're not expecting anything sort of out of consensus in terms of doing 50, 75 basis point cuts. That's crisis era stuff. So unless something big has happened, we're not in that world. But I think it will be a steady rate, a steady flow down that not everyone is priced for. They do, after all. Sorry, I just want to say they need to uninvert the yield curve, right? So they have to get through the 10-year rate at sort of 4.3 pretty quickly in order to do that, and then they need to keep uninverting it by cutting more. And so I think people are sort of thinking about 3 rate cuts, 4 rate cuts, appear to want a dead flat yield curve, which again is not going to be sort of even neutral for the economy.
Yeah, perhaps we should just skip the July meeting and head right to September, where everyone will be happy because the Fed will just signal that, yep, we're going to take a quarter point off, and that might open the floodgates to more incremental cuts, like you said, nothing drastic. Dylan, last time we spoke, it was the tail end of earnings season for the first quarter. Now we're here in the beginning of earnings season for the second quarter. Last time, banks had a really good quarter. Are we expecting that? Because there's been some news about banks recently that really rubbed me the wrong way.
Yeah, it looks like banks will be a little softer this time around. And of course, they open up earnings season, so that's where the focus is going to be early on. But I mean, we've been thinking quite hard about what we're going to see this earnings season and digging a little bit. And what's quite interesting is, there's a lot of attention paid to the level of concentration in the stock market right now in terms of what's driving the major indices, right? So you got these 7 stocks, already 5 stocks that are accounting for almost all the growth, and the rest of the 490 odd stocks in the S&P 500 basically flat, and a large share of them down. So sending very mixed signals about the state of the economy and the state of markets. Same is true in earnings. Earnings are actually, a lot less consistent, and breadth is a lot weaker than you would think just based on the headline numbers. And so with that in mind, what we're basically sort of telling our clients is that, you got to pick the industries that you really like around this earnings season. It's not going to be a broad story. Now, there are some tail risks. If we see a miss from one of the major AI-related stocks, that's the signal everyone's waiting for in terms of the bear market probably being over and slipping into correction and bear market. But more broadly, I think we're going to be finding signals that, consistent with the macro data, we're seeing the economy kind of slow down. Sectors where that aren't touched by these forces, so outside of telecoms, outside of energy, outside of tech, probably pretty soft earnings, right? And the banks, again, one of those places that we expect some softening. They can't fight, they're fighting an inverted yield curve, which is always difficult for banks. And by the way, when the Fed cuts, that's great for banks because that's going to uninvert, and then net interest income really improves quickly, and so does their solvency for the regional banks. So that's one place we're sort of looking in terms of positioning, but
I had been reading an article about J.P. Morgan Chase, and this affects all of us because J.P. Morgan Chase said that it seems like all the banks are going to do it, which is starting to charge for checking accounts. It seems that there's regulation out that's trying to lower the or cap the charge they can put on overdrafts and stuff like that. And in order to make up that money, they're going to start charging for checking accounts, which it affects all of us. Is this what you're hearing? And do you think this is actually going to take effect? Because last time they talked about this and it didn't happen. And I really don't want this to happen again either.
Well, you got to look at what that tells you, right, about the economy. In an ideal world and in a very well functioning economy, banks sort of play their main role in terms of essentially shifting money and shifting value between the present and the future, right? And the amount they charge for that is based on the yield curve and based on the future value of money and time value of money that's expressed in that, right? What we're seeing banks sort of doing now is they're facing an inverted yield curve, right? So from their perspective, it's very difficult to be profitable on the lending business because fundraising in short markets, um, at plus 5%, and they can't lend at a margin that sort of funds their business, right? So they have to look for other revenue. Okay, a lot of banks are going into, all the investment banks are now very big on private credit and funding private credit markets, which they withdraw from directly, but they're seeing ways to kind of be a service provider to that industry instead of do the lending themselves. We're seeing an increased focus on asset management and wealth management. And yes, for the consumer banks, they're looking for fee revenue because fee revenue is immune to interest rates essentially. And so, I think this tells us Fed policy is too tight, right? The banks are unable to properly fulfill their broad role in the economy, and they're looking for ways to kind of suck up funding from other sources, right? So hopefully it doesn't happen. I don't have any special insight on that, but the Fed can actually stop it if they wanted to.
Right. So the inverted yield curve means that the 2 year bonds, the interest rates are higher right now because that's what the Fed is really pushing because of the debt that we have, and the longer term bonds, the 10s, the 30s, those yields are lower. And
Exactly.
how do so when the Fed cuts interest rates, do you think that'll just automatically invert the curve?
Um, yes. So typically, uh, you see an upward sloping yield curve, and the reason is because compared to investing your money for a short amount of time, so it's sometimes you look at the 10-year 3 month or the 10-year 2 year, you can get kind of guaranteed returns on that very short lending, and that's essentially pinned to the Fed funds rate. They control what we call the front end of the yield curve. Now, of course, you could reinvest your money every 3 months, every 1 year, every 2 years, whatever, um, and earn a consistent rate of return, depending on what your expectations are of where short rates are going to go, right? So if you think that short rates are going to stay the same, absent anything else, you'd expect a dead flat yield curve. But you also might think that, okay, but the economy is gonna grow in the future. Plus, there's inflation I need to be compensated for those future cash flows, and that's what pushes the longer rates up, right? And that's a normal situation. That's the kind of situation which says there is a growing economy in the future, and that's what banks base their business models around, is lending now on future investment returns. But what we're seeing at the moment actually is that basically bond markets are telling the Fed, we think short rates are going to be lower in the future, which means, A, we don't think growth is going to be so high that it requires you to have very tight policy, and neither do we see major inflation risk coming down the tube that would lead us to put a premium on that, which would make the yield curve upward sloping. And so the way that uninverts in that kind of situation is to bring down the front end. In other words, to mean revert the yield curve, the Fed needs to cut rates, right? And you do usually get the whole curve flattening a little bit. So we would almost definitely see the 10-year rate with a 3 handle on it get to like 3.5% if the Fed cut down to say between 2 and 2.5%. And that actually generates a very high real return because of non-linearities and how bond returns work, which I won't get into now. But point being, it is the Fed who has uninverted the curve. They don't control the long end, especially when they're not doing QE. And it is the Fed who will uninvert the curve again.
Does it behoove the Fed to sell longer term bonds than the short, the 2 year bonds?
Yeah, well, so it's the Treasury who sells bonds, but
Right.
one of the most massive and difficult to explain policy decisions that we've seen by Treasury Secretary Yellen is, during the period of very, very low rates, she did not issue at the long end, right? So she could have locked in a huge amount of government funding at 10 years, at 30 years, for 2%. And instead, the Fed actually shifted to shorter dated issuance during that period, which is now all rolling over. And so there's a lot of issuance coming into markets that needs to be issued somewhere. With rates being very elevated, it's not easy to win in that scenario. And so what that means is that the interest burden of the U.S. government is going up and will continue to go up because that gets locked in as stuff rolls over, right? And so that's one of the things that's making markets a little more worried, especially on the longer end of the curve, around the 10-year, raising some questions about, okay, how sustainable is government funding if A, you're going to be quite loose, debt's already high, and you're increasing the cost to carry that debt, right? And so, yeah, that is definitely a problem and a very big missed opportunity not doing it previously issued on the long end of the curve.
So let's talk about the markets a little bit. The Nasdaq and S&P record highs. Dow's not terribly far behind it. You would assume that quarter point or that rate cut, we'll call it, is already worked in there.
Yeah, I think that expectation is in there. And indeed, the sort of full path of expected Fed cutting would be priced in. That is quite shallow at the moment. So, there's an interesting dynamic between the fact that a market dip would cause the Fed to cut probably faster, we think, at least we give them cover to. Lower interest rates, though, are also better for equities, right? So this is why we're seeing sort of every time there's soft data, which makes it more likely the Fed cuts, markets kind of do well. Every time there's strong data, oh, the economy is great, markets do well, right? That's the hallmark of a bull market. Everything's good news. Um, but one thing actually that we should probably point out in this market is that, as we discussed already, very high concentration. The stocks that are in the Magnificent Seven, their correlation to GDP growth is zero. Okay, these are stocks that are in a secular story and have been, in the case of say Microsoft or Facebook for a very, very long time, of industry growth. Right, the industry is sort of at the forefront of the economy, and it is kind of growing no matter what happens to the quote unquote real economy in terms of other services or in terms of like manufactured goods. And so, those stocks will be determined by their own kind of dynamics, right? When Nvidia misses an earnings report, that's when it's going to go down, right? Not because there's a recession in the rest of the economy. And we're seeing that in the price as well, because outside of these stocks, there's widely acknowledged kind of fragility. They have not been performing super well, but a lot of people are index investors, and so they've been benefiting from the rise in tech stocks. But yeah, I think to answer your question, I think the rate expectations are in there, and I think even more than that, for cyclical stocks, ones that are representing companies exposed to high interest rates, those have been underperformed because of how tight policy is, and rates would need to be a fair amount lower to kind of get those correctly priced.
I have a question about the volatility of the market. Right now, the VIX, the volatility meter or gauge, if you will, is right around 12, which is
Mm.
extraordinarily low. So, not a lot of people worried too much about the market, but unemployment is creeping up. Last time we saw something like this was right around 2007, and there was a very significant drop. Do you see that as a possibility? There is a correction coming. We know that, whether it's 5%, 10%, whatever it is, could it be drastic?
It could be. I think how drastic it is depends again on news on the Magnificent Seven themselves, whether or not it's just people sort of tailing back or whether there's something that causes a rethink of basically earnings projections for those companies and the AI theme a little bit, as you would have had in the late 90s, right, for some of the tech players and 2000. Um, but yeah, I mean, in terms of what the VIX is telling us, complacency. Volatility is low because everyone has decided on the narrative and is trading the narrative every day. And there's very little that is changing that narrative right now. And so you just get a steady creep up and very little in the way of measured vol. Um, it's not a coincidence that that happens just before times when we tend to get corrections in the market, because that always happens when there are surprises and complacent investors get surprised. So it's not the most reliable indicator. In fact, it would be doing the opposite of its job if every time it went down, it meant markets were about to blow up. But the longer it stays there, the more it tells you that there's kind of a bit of fragility building up into the markets.
So how do we protect ourselves from something like that? Do we take some cash out, put it on the side, say, okay, it went way down, let's pump it in there?
Yeah, people have stopped taking profits. It doesn't happen the way it used to. Partly it's because there's fewer active managers in terms of the overall share of funding that's now in index funds, and people just the whole point of an index fund is to let it sit. And so we're not seeing a lot of profit taken. And we would say now, for those who can, now is a good opportunity to do it. We would have said the same thing 3 months ago and 6 months ago. So timing is always extremely difficult to call. But that might be wise. Where would you park if you do think there's a correction coming and you're worried about it? If you're equities only, um, as we said, that tech theme is a little bit economically insulated. Um, but that's probably where the correction is centered when there is a bit of a rethink. So, but there are adjacent industries which are very strong. So things like utilities, which always outperform in a weak market, and now also exposed to some great secular kind of growth themes around energy demand, around data center build out, all that kind of stuff. It's good. There are certain REITs that are going to do very well, we think, and we quite like commodities. So we're pretty bullish on commodities. So commodity adjacent stocks are a good place to be. More broadly, in terms of a diversified portfolio, we love gold. We think gold's going to 3,000. It's taken a breather after the big performance earlier this year, but we see plenty of reason to believe that the sources of demand that have pushed it to where it is are still strong, and there are more that need to come online still. Basically, when sort of ETF demand picks up, once we get some dollar weakness when the Fed starts cutting, that's all very gold positive, and so that can move higher, we think, alongside the gold miners, alongside silver. And then we're sort of more deeply bullish, more structurally bullish on other base metals, especially the ones that are linked to kind of green transition technologies broadly. So that's how we'd think through. Oh, and by the way, we had a pretty bullish call on Europe earlier in the year. That's closed out. Politics has kind of made that fairly difficult to maintain. We think there's a lot of investment coming into the UK with the change in government. The first period of stability that the country will see after the 2016 Brexit vote. There is a lot of investment that has not happened in the UK economy because of that and because of COVID. And investors are now seeing a period of stability of effectively sound management of the economy and much more sensible management of the economy coming. And so we think there will be actually a rush of investment in the UK, and we think markets will outperform that.
So the UK is on the rise, at least economically. They've been a little bit of a disaster as of late. What about Canada, Dylan? I know
Mm.
that Canada's had their problems as well, and that doesn't. It's going to take a long time for them to crawl out of where they are.
That's true. Before the bad news, I'll give you some good news though. If you're an investor outside of Canada, the loonie is very weak. There are parts of the TSX that are very well exposed to rate cuts, and Canada's a commodities producer. So there are definitely ways that Canada can give you exposure to some of the themes that we've just been talking about, which are quite positive. But broadly, the Canadian macroeconomy is in a pretty poor position. Um, there has been a very large immigration surge, which has been kind of masking underlying deterioration in the Canadian economy. So increasing measured total GDP at the same time that per capita GDP has been shrinking. Productivity has not grown since in the last decade, basically. Um, and the ability of the economy to generate growth has become weaker and weaker. There's also an ongoing house price house price affordability. If you think it's bad in the U.S., it's really bad in Canada. And so that is weighing quite a lot as well. People are hoarding COVID savings instead of spending them. And the Bank of Canada has sort of acknowledged this. And as it sees inflation settled within the target band, which is 1 to 3% in Canada, and the labor market has cracked up sort of on a 6 months ahead of the US, basically, in terms of the labor market breaking up. And so that's all allowed the Bank of Canada to start cutting. We think they will continue to cut. They will cut faster than the Fed. That means a very weak Canadian dollar. So that's one investment position you can take. And there are obviously industries, tourism, a few others that benefit quite well from that.
So last thing I want to talk about is the debt. Almost nearly 36 trillion at this point, and with interest rates not coming down, we need to service that debt at a very expensive rate. Obviously, a rate cut will help in a minuscule way. more would definitely help. Where do we go from here? Because neither one of these presidents is going to stop spending money.
Well, more rate cuts help as long as it's not seen as license to borrow more. So it all comes down to the fiscal policy that happened. And as we discussed earlier, that comes down to the balance of power after the election. But the sort of bold fact is that nothing in this election campaign has been about consolidating the national debt. No party is running on the honest idea that the U.S. needs to renegotiate its social contract in order to manage down its debt. There are sacred cows that need to be looked at, which neither party has any interest in looking at, and which it would, to their credit, be very unpopular in an election season to start raising things like we need to adjust Social Security, etc. But that's the only way. It's the only way. And the sort of buildup of higher incremental cost of borrowing is already happening and will continue to happen unless the Fed floors rates to zero across the yield curve, which is not possible. So it's a big reason for concern. Equally, these things don't happen all at once. It takes years and years for a fiscal crisis to build up and develop. And so, the line we're running is that the 2028 election will be run on the debt. And it's going to take a whole build up. Now, as we've said, if Republicans are in control across the board, that is going to make that deterioration more rapid, more inflationary. And so, that's one outcome that we should be on guard for. But equally, we don't see a way for cross-party consensus to deliver a sensible and growth positive consolidation in the event of a Democrat winning the White House either. So it's going to get worse before it gets better on the debt side.
2028, we could be looking at 40, 45, or even 50 trillion at that point. And easily. boy, it's, my grandkids are going to be paying for that. That's for darn sure. Dylan, where can we find your research and where can we find you on social media?
You can find our research at rosenbergresearch.com. And you can see a lot of it before you have to commit to anything because we do a 1 month free trial of our full suite of products. On social media, you can find me on LinkedIn. You can listen to me weekly at my podcast, which is Rosenberg Research, or the Rosenberg Roundup, rather. So we do weekly roundups of the week in economic data and macro land. We talk a bit about some special reports that we've been working on or thematic things. And we also do occasional interviews with sort of movers and shakers in finance. So that's where you can find me if you want to hear more from me.
I have listened to the podcast, and if our viewers want to listen, it's 15 to 25 minutes. It's great stuff, and it's very, very informative. So Dylan, thanks so much for joining me. I really appreciate it, as always.
Thank you, Andrew. Always a pleasure.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to Wealthion.com, sign up for a free no-obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. If you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.